Hi everyone. Welcome to Positioned.app. Today we're diving into Bollinger Bands, a powerful trading tool that helps analyze market volatility and spot opportunities. Created by John Bollinger in the 1980s, Bollinger Bands consist of three lines: a middle band, which is a 20-period simple moving average, an upper band at SMA plus 2 standard deviations, and a lower band at SMA minus 2 standard deviations. These bands adjust based on market volatility. When volatility increases, the bands expand. When it decreases, they contract, acting as a cushion for price movements. Why does this matter? When the price touches the upper band, the market might be overbought, suggesting a potential sell signal. If it touches the lower band, it might indicate the market is oversold, signaling a potential buy opportunity. Now, we'll analyze three stock movements using Bollinger Bands to understand how traders can use them for better decision-making. Let's begin with the bullish breakout pattern. This chart displays a classic bottoming formation before the bullish move begins. Initially, the price consolidated near the lower Bollinger Band, creating a potential reversal zone. As buyers step in, we see price action moving from the lower band toward the middle band, which acts as dynamic support during several pullbacks. These consolidation phases near the middle band create excellent entry opportunities. The most significant feature here is the strong breakout above the upper Bollinger Band, accompanied by increased volume. This is a high conviction signal, as prices typically remain within the bands 90% of the time. When they break out with volume, it indicates exceptional strength. Pay special attention to how the bands themselves widen during this movement, confirming increased volatility and strong directional momentum. Also note how the lower band begins curving upward, supporting the overall bullish trend. Trading tip: after such strong moves, watch for potential pullbacks to the middle band, which often provide secondary entry opportunities. Now let's examine a completely different market environment, the range-bound trading pattern. Here we see a market that's predominantly trading sideways, with no clear directional bias. The middle Bollinger Band runs horizontally, confirming the sideways nature of this trend. The price consistently bounces between the upper and lower bands, creating a channel-like pattern. This behavior creates multiple trading opportunities, while the market decides its next major direction. Look at these multiple tests of the lower band that resulted in bounces, indicating support. When prices touch the lower band and form green candles, it often signals potential buying opportunities. Similarly, these touches of the upper band led to reversals, suggesting resistance. These areas typically present potential selling opportunities in a range-bound market. Notice the relatively consistent width of the bands throughout most of the period, indicating stable volatility, typical of consolidation phases. Trading tip: in range-bound markets, consider buying near the lower band when bullish reversal patterns appear and selling near the upper band when bearish patterns form. However, always be prepared for an eventual breakout from the range. Our final pattern shows a powerful bearish trend followed by potential early signs of stabilization, a pattern that can offer both shorting opportunities and eventual reversal trades. This chart displays a textbook bearish sequence. Notice how prices consistently remain below the middle band while making lower highs and lower lows, a classic downtrend signature. The significant widening between the bands during the steepest part of the decline indicates heightened volatility and selling pressure. This expansion is typical during strong directional moves. Pay attention to this pronounced volume spike, which coincides with the most dramatic part of the sell-off. This suggests a potential capitulation event, where the last remaining bulls finally surrendered. In the rightmost section, we see potential bottoming signals forming. Prices have begun to consolidate above the lower band, forming some green candles and showing decreased downward momentum. The lower band has also begun to flatten and slightly curve upward. Trading tip: during strong downtrends, short positions can be initiated on bounces to the middle band. However, when prices begin consolidating near the lower band with decreasing volatility, it's wise to tighten stop losses and watch for potential reversal signals. No tool is perfect. Always consider market context and use proper risk management. For better accuracy, combine Bollinger Bands with other indicators like volume, trend lines, or RSI, the Relative Strength Index, which we'll dive into in the next video. If you found this helpful, like and subscribe for more trading education content. Also sign up for Positioned.app for real-time swing trading signals. Let's make smart trading decisions together. Thank you for watching. Until next time, happy trading!